Welcome to the Titans of Industry show. I have a bombshell interview for you today. This guy is the original whistleblower. In 2009, he saw what was going on in the COMEX and on the over-the-counter markets with precious metals manipulation and rigging, smash downs. You know, he's seen it all. He's a 40-year veteran in financial securities and commodities markets. He's been all around the world with this message, and in 2010 in the CFTC meeting with GATA, he was the one who told the testimony about what's going on in the precious metal sector. I'm very glad to have him on. Andrew Maguire, how are you, sir?
Hey, great to be with you, Loya.
Hey, Andrew, first of all, we talked off the air about what's going on with this revaluation. Can you explain this, please?
Yeah, I think probably your listeners are probably much more aware of how the markets are managed. Let's just say, use the word managed by central planners. And I think the first thing, I think I saw interview with I think it was a Kitco interview. I barely ever watch any of those kind of things, to be honest. But where denial of even amongst the gold community that, well, it's how do you know that gold is even manipulated and I think this sort of leads into what you're talking about, which is people don't understand that gold and silver are the monetary metals are actually traded as a FX cross, a foreign exchange cross. They are a currency, unlike any other commodity. So, we all know that the central planners manage, and admittedly, openly manage, let's just use the word manage, which is more, let's just say, as a nice way of saying manipulate or basically manipulate all the currency crosses. And they openly say, well, yeah, obviously we manage those on a daily basis. But then, of course, deny that gold is ever manipulated or quote unquote managed. And yet it is one of the 5 trillion a day FX crosses that get traded on the markets. And obviously, gold in itself is a 5 trillion a year currency cross. And so obviously it is managed along with other currencies. So once, people get over that concern and say, well, yeah, okay, yeah, well, it has to be. So it's not, you can't just say it isn't, because it simply is. But I think we've seen some major shifts recently, and I think we can talk about the Goldman Sachs thing, where I've recently gone public about them going wrong. But I think this is all about a revaluation of gold, and when you see Goldman coming out with a statement. I think I'm sure you saw this statement from Jeff Curry of Goldman Sachs, and it was an article. It was picked up by Reuters, and it quote, he says, if buying gold, don't buy futures or ETFs, buy the real thing. And then he goes on to say the lesson learned was if gold liquidity dries up along the broader markets, so does your hedge. And unless it's physical gold in a vault, the true hedge of last resort. So, I mean, honestly, what more do you need than this perma bear coming out, who was calling for $800 gold just at the end of last year, suddenly comes out and talks about they're really clearly rethinking their underwater allocated positions. And it really is obvious. They don't say anything unless they're talking their own book. And this is the first public inkling that Goldman Sachs is now talking up a long physical position. And so really, let's lead into to really what your question is about is, this is going to be, we all know there's a massive underwater derivative position. We all know, and we can go into the detail of that if you want, but I mean, I think a lot of your listeners are really switched on, and we don't need to sort of go through that detail. But, so is there, who's going to reset the value of gold? It is so undervalued. We've seen a massive outflow of paper market liquidity move away into the west, into the eastern markets, and that's taken away the very underpinning for a massive paper market derivative position. And we all know Reserve Bank of India in 2010 2010 said it was 92 to 1, that every, the 92 ounces of paper gold get traded for every ounce of physical. Okay, fair enough. That does not include derivatives. It could be closer to 500 to 1, but certainly significantly higher than that figure. So this is a subject that we've explored in depth recently with my clients, and some of my clients are sovereigns and very large institutions. And this is important because it's affecting their decisions. Really, in summary, we can go in. Obviously, there's a huge subject here, and you could go on for, it would be far too long for this interview. But in summary, all China has to do right now is announce its aggregated holdings of close to 25,000 tons. Now, people say, well, yeah, I thought maybe it was 15, 20. No, but pretty close, we think, to 25,000 tons. And this is gold that's salted inside the state-owned banks, and that really, with a keystroke, can be called reserves. Now, the resulting price explosion of such an announcement would lock out any other central bank from accruing gold reserves to compete with China. Now, obviously, at $1,300, $1,200, other central banks can accumulate. If it jumps up to $5,000 or $10,000 an ounce, then who the hell can pay a rehypothecated position if you're the Fed, or who the hell can, which other central bank can suddenly accrue anything close to that if you're paying significantly more per ounce? So there's one side of the equation. And if the Western central bankers don't hurry up and settle close to $1 trillion worth of accrued gold and silver debts, first, it's going to be too late. And the preferred option would be to exercise their right to settle all unallocated gold obligations for cash without a default. And we all know that on an unallocated contract, LBMA unallocated contract, you can settle for cash. So, and it wouldn't be considered a default. So perhaps we'd see a settlement on a Friday night. Everyone gets settled for cash, and then on the Monday morning, you'd simply say the gold price will find its own level. And obviously, that's going to be significantly higher. But looking under the covers, now we see Goldman moving net long physical. This really reflects a clue to a shift in the thinking by central planners. Now, this is where the battle really is, and it will be resolved very soon. And it's very important information, and why I and some very influential entities are choosing to accumulate as much physical into any weakness, whilst also seeking to rebuild some shorter-term long positions in what is actually a looming opportunity. Now, ideally, China would like to defer the price reset for as long as possible, and that is in order to acquire as much gold as possible and related collaterals such as producers and a multitude of related infrastructure at a discount. But the Western central planners are aware this comes at a cost. And how long before this reset occurs? It's obviously, this is a battle underway right now. This is the art of war. It will come when the least expected, and given all the unprecedented signals we are seeing soon. Now, given the physical market is no longer in the Western central planners' control and supply is tightening at bifurcated prices, the West cannot afford to wait much longer, or China is going to make that move. So this is really, I hope, in summary, that kind of puts it into a nutshell as to what this battle is going on right now.
Now, if I understand you correctly, what you're saying is that the incentive of the Western central banks to suppress the price of gold in order to show that their currencies are stable is not going to be their main priority if the Chinese want to start settling debts in gold, and then the US's holdings play in their favor, and they'll want to revalue gold higher so that they can settle for better prices. Now, why did Germany go ahead and take their gold back? What was this about? And what do you think of Steve Mnuchin, the Secretary of Treasury, going into the Fort Knox and claiming that the gold is there? What is that about?
Oh, well, that was ludicrous and laughable. And obviously, I understand that he only announced that visit after a speech he was making, and I think there was about a three-hour window for anyone to any other reporters to come and challenge it or look at it. But obviously, what a joke! I mean, you go in. Look, I've just come back from a visit to Swiss vaults, Liechtenstein vaults, and when you go and look inside a vault, you go and look at every single vault. You don't just go in and say, if I've got reserves sitting in a vault and I go and visit it, I don't say, oh, look, tell you what, you can choose which vault to open of my holdings. I don't worry about looking at the rest of them.
It's not like asking your wife to see if the car is in the parking lot. You need to. This is the Ford Knox. It's not like,
yeah.
Could you please check if no one's stolen our car? It's not like a 1 minute thing.
Yeah, exactly. So going in and making a statement that all is well in La La Land, just by having someone open a vault of their choosing, and you have a look, okay, there may be gold in there. And I'm sure there is. Of course there is. I don't know what quality, whether it's melt gold or not. Very likely is melt gold. But the point is that you cannot call that an audit, and you cannot make a statement to the U.S. People that all is well. And you mentioned Germany just now. Well, okay, so this is where the first red flag rose. So Germany asked for a tiny 300 tons of gold back. That's nothing in compared to the 8,500 odd tons floating around. And why does it take 2,500 odd days to say you can get it back in 2,500 days? But hey, I can put 25 tons of silver on a plane to India in a single day. This could have been done in a week. So obviously it wasn't there. And it's pretty obvious it wasn't there. So that raised a red flag. And if you remember, the very day Germany asked for their gold back, it was also the day where ABN AMRO said they were going to settle their clients in cash. And already we had some sort of cracking of the system. And we saw a massive hammer down. And that was a reaction, I think, an aggressive, proactive reaction by the Fed to say, don't even think about buying gold in these circumstances. There's plenty of gold around. We're just choosing to take 2,500 days to send it back to Germany. But what a joke. I mean, obviously any thinking person would understand, or if it was my gold and I said, look, I'd like it back, and I'm told I'm going to wait all this time to get my gold back, I'd be freaking out. I'd be down there at the door with a Brinks truck saying, load it in now.
I totally understand this. Now, I want to get your take on another very important matter, and that is the function of the Fed, or basically the performance of gold once the Fed starts to unwind its huge balance sheets of mortgage-backed securities, bonds, etc. Now, if there's no buyer for most of these, or if they'll have to sell for much lower prices, because we're talking about $3.7 trillion at the high end, or $3 trillion at the low end of assets that they need to liquidate. Now, if there aren't enough buyers, this will create inflation within the U.S. banking system. And what I think we're seeing is a coordinated liquidity operation using other central banks, the ECB and the Bank of Japan, that they will come in and basically they will hold these hot potatoes instead of the Fed, who's going to appear like it's liquidating. I don't think the market will buy it. And I think we're headed into a multi-year bear market for the dollar. Or do you agree with this, or do you challenge this? Where are you with regards to the U.S. dollar and the Fed unwinding?
Well, in fact, I have to agree with what you just said. I mean, the U.S. dollar. We've been watching the footprints around that, and specifically, bear in mind that everything I do is related to gold, and we look at all these currency crosses as they relate to gold and what they mean for gold. And definitely, the dollar is in a massive decline here. I mean, gold, on the face of it, we talk about, people spin gold as in a bearish trend, that it's never going to rise. Gold's outperformed the S&P this year, and it's up close to 30% from its lows into a rate hike cycle. Now yesterday we see more plate spinning from a disingenuous Fed that's scrambling to hold the reins while the wheel falls off the wagon. And when the Fed does raise rates, or whether they do or not, the bullish price of gold is there. Far bigger things are at work now. And so I think that basically gold is the leveler here. And regardless of what you've just discussed, yes, there'll be some juggling of the potato between the other central banks. But ultimately, gold is going to overrun everything, because you're going to see gold revalued higher. And we just discussed that war that's going on right now. And this is based upon why you cannot sit back and wait to revalue. And one side or the other has to do this pretty quick. So this whole thing is a broken system, and these plates are not even spinning well at this point. And we're watching something that we're going to look back at this point historically, and it's not very far from this point. We'll be looking back at this and seeing everything you've just described, and the dollar completely in the tank.
Now, what do you think will happen with silver when this happens to gold?
Silver will outperform gold enormously. I've just come back from the largest holders of silver globally, and that's in Switzerland. Now, there is so little silver. Now, for example, to fill a large order of kilobars now takes over 3 weeks, and each and every bar is a brand new 2017 bar. Okay, so that is not the wholesale market. The wholesale market is standard bars. That is 1,000 ounce bars, and they are supposedly liquid. However, there is probably, in reality, and I base this upon, as a wholesaler, and I base this upon supply and demand in the wholesale market, there's likely only about 250 tons of available sovereign standard bars that are infinitely, and these bars are infinitely fungible. So
in dollar terms, 250 million tons is what?
250 tons. 250 tons. Yeah, well. That's. Let's just say it's $18, an ounce. So, let's have a look. So, what's that? It's very little. Say 4.5 billion or something.
That is insignificant when talking about the global economy, and when a country, even a small country, wants to back their currency with silver, it's impossible with $4.5 billion.
Right. So silver is the rocket ship. I see that as being, when gold is revalued, silver will exponentially. And bearing in mind, there's a huge amount of short interest in silver in the COMEX markets. And I think the COMEX markets is irrelevant, to be honest. Again, we're going to see a cash settlement likely on the COMEX futures exchange too. But the amount of short interest in silver is going to literally be run through. I cannot see silver at less than $100 an ounce, and the ratio really for silver should be back into less than 30 to 1, and historically we know could be 15, 16 to 1. I can see that returning. So anyone can do their own math on this based upon the price of gold as it is revalued, and if gold is revalued at higher than its 2011 highs of say $2,000, you can just do your own math on that. It is enormous. Silver is, to me, the investment choice for most of my clients. And in fact, I'm seeing a lot of clients now saying, I'm actually going to put some of my silver into gold. Some of my gold into silver. But the minute that happens, there isn't going to be enough supply. And here's the issue about that too. The actual silver that is used industrially, like the likes of Samsung, Nokia, and the people that actually use it in their production, do you think they care if the 1 gram of silver in an iPhone is $1 or $5? They don't care. What they're going to do is, if they see supply tightening and they've been privileged to sit back and have a just-in-time arrangement where their silver gets delivered just in time for production, they see this supply tightening. And when we see more and more silver investors coming into silver, and it does tighten the only available supply there is, then you can bet your life these guys are going to come out and buy literally tons and tons and tons of silver to ensure their production lines do not stop. They do not care if it's 18 or $50 an ounce.
There's so little in every product that they make, so, and obviously they're not gonna tell their clients, hey, we don't have silver, so we can't supply our services and products to you. I want to also, lastly, Andrew, touch on the point of vaults. There's a lot of people that simply do not buy precious metals because of the hassle of storing them in vaults and paying the storage fees. Now, this is all changing right now. The storage fees are going very, very low. I know from my own vaults, and I know that there's so much storage solutions right now around the world. Do you think this will play into effect? There's so many people who have not bought gold and silver and have bought the ETFs just because it's easier to do so.
Yeah, it is. And in fact, it is actually, if one weighs up the cost of carrying an ETF, it is actually more efficient to actually correctly buy and store that independently in a vault that is secure and physical, segregated, and all the knowledge that you have that gold and silver in a vault at a price that is actually likely less than the carry cost of ETFs. This is a huge spin of disinformation that's out there. And I sit on the advisory board of the Allocated Bullion Exchange, and we've got global vaults all over the world, and we see people, asset managers, coming in and buying gold in size, vaulting it in jurisdictions that they personally feel are safe, and literally finding, these are people that are coming out of ETFs and finding that it's actually cheaper to vault it in physical form than to pay the costs of an ETF.
Well, that's perfect. Andrew, thank you very much for taking the time. I want to also just wrap up this with, do you have any information that you want to share with our audience that is super critical for them to know right now?
Well, I think that this bit of plate spinning that's going on right now is a joke. Any dip here, and let's look at the options levels. Let's look at the commercial footprints. Let's look at where the sovereign levels are. Anything sub 17.5 in silver is a short covering point for commercials. Anything sub 1325 in gold is actually, again, being used as short cover point for commercials. And of course, you won't see that in the COT report this week, because all moves happen always on the day after the COT cutoff, which is on a Tuesday. But watch it flow through in the next week. But really, the equation is synthetic markets got a little bit above the sovereign levels. That's now being rinsed heavily out. Commercials don't want to see silver too low because it causes an outflow of physical they have to stand up and deliver against. So